My dear students, today I would be discussing the instruments of money market with you. There are 5 instruments in your syllabus which we have to discuss. That is call money, treasury bills means the T bills, commercial bills, commercial paper that is also known as CP or CD means the certificate of deposits. So these 5 we will discuss one by one. The first one is treasury bill. Treasury bill means that short-term instrument which the central government issues to the financial institutions or the general public in order to meet its short-term financial needs. Its maturity period cannot be more than 1 year. They are issued by the RBI on behalf of the central government. Usually their maturity period is 14 days, 91 days, 182 days and 364 days. These bills are generally bought by commercial bank, non-banking financial companies means the NBFCs, LIC, UTI, GIC, etc. These treasury bills are of highly liquid nature because the RBI is ever ready to buy them on discount. They are issued at less than the face value, while the payment is made at the face value. The income of the investor on a treasury bill is equal to the difference between the issue price of the bill and its payment. This difference is known as discount. Since interest on the treasury bill is not paid at a fixed rate, so that's why it is called zero coupon bond. Can you see here? These are also known as zero coupon bonds. Zero coupon bond means a financial instrument for which no interest is paid but it is issued at a discount, meaning it is issued at a price less than the face value while the payment is made equal to its face value. Correct? And the minimum amount of treasury bill is rupees 25,000 that is had been shown here. It can be purchased in the multiple of rupees 25,000 only. Correct? So if a question is asked that can a treasury bill be issued for 30,000, 20,000? The answer would be no. Remember it. What is the procedure of the treasury bill? It is issued on the basis of discount. Already I have said this, and this discount is determined in two ways. Number one, on the basis of prefix discount. For example, a treasury bill of the face value of rupees 1 lakh for a period of 91 days is issued for 95,000. This means a creditor pays 95,000 and will get rupees 1 lakh after a gap of that 91 days period. Correct? In this way, 5,000 will be in the form of discount or interest, you can call it. So you are paying 95,000, you will get 1 lakh rupees. No, it is for those who are investing into it, and you are getting 95,000 and after some time you will have to pay 1 lakh rupees if you are taking the advantage of this treasury bill. Means for government I am talking. Then the another way is that the rate of discount is determined on the basis of auction. For the purpose of auction, the Reserve Bank of India, through the medium of newspaper, invite tenders, and the interested person submit the rate of discount through the medium of tender to the Reserve Bank of India. On a fixed date, the tenders are opened and the tender quoting the minimum rate of discount is accepted. This is also another way, right? Now let us talk about the commercial paper. Commercial papers are again unsecured promissory note which are issued by well-reputed companies to meet the demand of short-term, seasonal and working capital needs. For example, in order to expand its business, a company is going to issue suppose equity shares. So the company shall have to bear heavy flotation cost. Correct? What is flotation cost? Flotation cost means the expenditure incurred in issuing a security, say share or debenture or preference share. This expenditure is made in for making payment of brokerage, underwriting commission, advertising, printing of application form. All these will come into the flotation cost. Means the expense which you are spending to raise that fund. Correct? So the money spent in meeting the flotation cost can be met by issuing commercial paper. This source of finance known as bridge financing, right? Now what is bridge financing? Bridge financing refers to a temporary arrangement of finance that bridges the gap between the need of long-term finance and to secure it. For example, to arrange finance to meet the flotation cost by a business. And who buys it? Their buyers are usually banks, insurance companies, unit trusts, and firms. They can be sold in two ways. One is directly, another is indirectly. Means the company can directly sell the commercial paper to the buyer or can take the help of some agencies. The minimum face value of a commercial paper is usually 5 lakh rupees. How it is done? See, basically the commercial papers are issued for a period of 15 days to 12 months. They usually issued on discount, but sometimes they are also issued on a definite rate of interest. There is no active secondary market available for them. However, the issuing company buys them on request also. So this is all about the commercial paper. Usually they are sold at discount and redeemed at par. This also you have to remember. Third one is the call money. Somewhere it is also known as call loans. So it means that is that type of loan which can be which payment can be made at a short notice either by the borrower or the lender. Under this, the maturity period of the loan is between 1 and 15 days. On this very basis, it can be said that call money are absolutely liquid. They are considered almost equal to cash. They are generally used by the commercial banks to maintain minimum cash reserve ratio with the Reserve Bank of India known as cash reserve ratio, minimum cash balance, that is cash reserve ratio. What is cash reserve ratio? Are you aware of this? It refers to the minimum cash balance that a commercial bank has to maintain with the RBI. The CRR is determined by RBI, which may change from time to time. And this change in CRR affect the amount of funds available to be given as loan by commercial bank. So the call money is a method under which banks borrows from each other so that the CRR is maintained. The interest rate used for call money transaction is known as call rate, which varies from day to day and sometimes even hour to hour. See, the number of persons dealing through this instrument is very limited because but every transactions involve a big amount. So the banks only deals into it. The lowest amount of this instrument is 10 crore. Generally, it has been observed that most of the transactions are rupees 100 crore like this. The call money transactions are made generally on the telephone. The paper formality and all these things are completely done after the paper formalities is completed afterwards. The lender issues a check to the borrower through the Reserve Bank of India. In lieu of it, the borrower gives a call money borrowing receipt to the lender. The borrower returns the money through an RBI check and get it back, means the receipt he gets it back. The important thing to note in the context is that both the lender and the borrower can pay or ask for payment even before the time of maturity by giving a notice to this effect. Right? There is a very important line written here. There is an inverse relationship between call rates and other short-term money market instrument, such as certificate of deposit and commercial paper. Yeah. So, means that a rise in call money rates makes other sources of finance, such as commercial paper and certificate of deposit, cheaper in comparison to it. So when those become cheaper, then the bank prefer to raise the funds through those sources, not through the call money. Correct? See, usually this question is asked by the student that how there is the inverse relationship between call rates and other short-term money market instruments. So for that, I want to explain it in a very simple word. Please listen it carefully. The things would be clear to you. See, as we know that the call rates are the interest rate that are charged on call money. Call money is one of the many instruments that prevails in the money market, correct? For raising the short-term finance. So now whenever call rates rise up, it means that an organization needs to pay more amount of interest if it resort to call money. If it resort to call money to meet its short-term financial needs. This means that call money has become a relatively expensive as compared to the other money market instrument. Correct? So it is quite rational that organization will now resort to other instruments which are now cheaper as the rise in call rates made call money expensive. Correct? So on the other hand, if there is a fall in the call rate, then it means what? That call money is now cheaper. Since the interest payable on call money is lower, this makes resorting to call money to meet its short-term finance requirement. So what will happen? To meet our short-term finance requirement, we'll get attracted in comparison to other instruments such as commercial paper, certificate of deposit. So in such a scenario, the demand for call money rises up. So these opposite movement between call rates and demand for other short-term money market instrument confirm the presence of inverse relationship between the two. Correct? Hope this is clear. Now let us discuss the certificate of deposit CD. Certificate of deposit is a negotiable instrument which can be transferred after a certain period by an endorsement. It is issued by the scheduled commercial bank and the Indian financial institutions like IDBI, IFCI, ICICI, SIDBI and Exim Bank, etc. Certificate of deposits are issued to individuals, associations, companies, corporation, etc. The face value of the certificate of deposit is a minimum of 5 lakh. An investor has got to get certificate of deposit of the minimum amount of rupees 25 lakh. How it takes place? Certificate of deposits are issued for a period ranging from 91 days to 1 year. They are issued on discount. An investor can transfer the certificate of deposits after a gap of 45 days by an endorsement to any person. So a stamp duty has to be paid on the face value of the certificate. Now there may be a question that what is the difference between certificate of deposit and fixed deposit, which we call as FD. See, CDs are freely negotiable, FDs are not. CDs can be issued for a period of 91 days to 1 year, and FDs may be issued for a minimum period of 14 days and maximum there is no limit, and it depends on the bank also. Remember it. CDs are issued at a discount on the actual amount of deposit held, and FDs are issued for the actual amount of deposit held. Correct? Now let us talk about the commercial bill. It's a negotiable instrument which can be easily transferred. It is issued to finance the credit sales. The seller means the drawer draws the bill and the buyer means the drawees accepts it. You have already studied in bills of exchange. The buyer honors the bill on the due date. If the seller needs money before the due date, he can get the bill discounted from the bank. You remember in class 11 you have studied in your accountancy that you can get it discounted from the bank. It's a short-term instrument generally issued for a period of 90 days. How does it happen? Basically, a seller writes the bill and the buyer accepts it. After having been accepted, this bill remains in the custody of the seller. He can get this bill in cash from the bank and meet his requirement for money. In this way, the seller gets his money and the buyer gets goods on credit. And when this bill is accepted by the commercial bank, it is known as commercial bill, right? See, this topic is very important from the examination point of view. Usually the question is asked from this and the student sometimes get confused among these five. So I am suggesting you this nice and easy way where you can see all the instrument at a glance. What you have to do, you just write all these five instruments here and put the uh, basis on which you can establish a comparison between these. Like who issue it means the treasury bill is issued by RBI on behalf of central government, so you can write it here. Same way commercial paper, who issue, write it here. What is the nature of these and how much is the duration, like 1 to 91 days to less than 1 year, or 14 days to this much, whatever is there, you just write here the duration. Then you can write here the purpose, like it is to meet for short term requirement, this will be acceptable for all, but it is for working capital requirement, like call money is to meet the minimum cash reserve ratio. So this way you can write all the purpose. You can add here one more column, that is of amount, or the minimum amount or the maximum amount. You can write here the minimum and maximum amount. Like for treasury bill, it is 25,000. Same way you can write for others also, that how much is their amount. And you can think of, you know, like I suggested you five. You can make it sixth one also. You write it, make a table and send it to me. And for sure, I would be awarding the best table whosoever sends me, and I will give you a certificate also for this. Okay, so take this as a challenge and do it. Thank you.